Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Julian Brigden, co-founder and president of Macro Intelligence 2 Partners, a global macroeconomic research firm, to discuss advising clients trying to navigate markets during this time and how investors can protect themselves during these vulnerabilities. Julian, it's great to have you with us. Welcome to Trade Talks.
Thank you very much for having me on the show, Jill.
Tell us about Macro Intelligence 2 Partners and the type of research you're producing.
So we formed the firm about 11 years ago. It was actually formed at the behest of a couple of my clients at the time who were hedge funds. And we have a large sort of institutional client base that we advise. So hedge funds, real money accounts, family offices, et cetera, et cetera. But we also have a retail product that we sell as well. We do it through Real Vision, which is another online contributor. And so we sort of cover both ends of the spectrum. And really what we aim to do is to replicate the decision-making process that you would see in a macro fund. So we'll talk about the fundamentals of the world, and then we'll try and make money out of those, whether it's, where we think there are abnormalities and where there are discrepancies in the markets which haven't quite factored in yet the macro developments.
Well, let's talk about that. We're looking at Fed policy, strategy shifts, inflation, interest rates, geopolitics, of course. It feels as if we're in a historical inflection point for the global economy. So what are you keeping an eye on here?
So we totally agree with you. We think, in fact, we've been talking about this for a couple of years now, and these things move very glacially when you talk about those sorts of trends going on, whether you talk about, inflation, whether you talk about geopolitical shifts. These things happen very slowly, but we do believe that you're at a truly generational inflection point. We don't think we've seen anything like this in geopolitics since the collapse of the Berlin Wall in 1989, and in terms of inflation, really since the late 60s. So when we look at all those factors, we think that we're moving into a very, very different investment environment than the one that we've certainly been in. Let's just sort of zoom in and say the last decade. Right? In the last decade, we've benefited from hugely supportive central bank policy post the global financial crisis, where the central banks have always been able to err on the side of caution, have always been able to essentially support markets because they were fighting deflation or disinflationary risk. That meant that there was no issue when things slowed down to cut interest rates aggressively, pump more liquidity into the system and pump up asset prices. That's changed very dramatically, we think. And that has enormous ramifications for investors. And I'm afraid I think that people are very poorly positioned going into that because there's a lot of inertia that you build up over a decade of getting the trade right, Jill.
So, Julian, let's follow up on that before we talk about how you're positioning in the market. With global central banks and just continuing to pump money into the system and not allowing markets to perform their function, and some things do fail, and we have to pay the piper at some point. And, even when you think about the R word, recession, these are part of natural business cycles. And it just seems as if we're not allowing market forces to do their thing.
Yes, you're totally right. I mean, it just does appear that that is no longer a viable, politically acceptable thing, right? And I do understand that when you get down to the zero bound, the lower end of inflation, right, that it becomes much more complicated for these central banks. But I think the fundamental issue that we're tackling now is that we really overcooked it during COVID, right? I mean, I think we can say that with hindsight, hindsight is 2020, but we spent between what we did in both in monetary policy and in fiscal policy, multitudes of what we spent during the global financial crisis. And now we're having to deal with those excesses and removing them when you've driven up equity prices as much as you have is extraordinarily hard. And, people think that I'm a mega bear when I say, well, what if Apple corrected somewhat? Now, I think there's other things you own, but it's up 240%, Jill, in 2 years. That's not normal price action in any world, absent these central bank policies.
And that's what we're talking about now. Certainly mainstream media, as goes Apple, so goes the market.
Correct.
So I certainly understand that concentration risk. So with that said, Julian, how are you advising clients trying to navigate markets during this time? And how do you protect them with these vulnerabilities?
So look, I mean, I think, institutional clients is a very different set of circumstances than you have for, say, retail clients, right? Protecting yourself to some degree, and I face those same issues as I look at my own personal portfolios that invested in, pension funds and so on and so forth. It's actually quite difficult to position in those. We've been positioning for really a year and a bit now in sort of the commodity space, but there even comes a time where that gets overvalued, right? So then you have to start thinking about, reducing some risk there, going into cash, right? Cash can be if you think there's a correction coming, and if it's potentially a big correction, which I don't think we're there yet, but I think we could be building to those circumstances, that nothing is safe, right? Because if we get a broad volatility shock across the market, what professional investors call a VAR event, then all risk is going to be reduced. And even the winning trades don't do well. So, if you can short some things, I think I like being long emerging markets at this point. I love being long things like, the mining and metals ETF. I like the energy ETF. But to be outright long, if things start to get too wobbly and nervous, you've got to be able to short something against them. And there are short ETFs that you can do it, but not every investor is going to want to do that.
Yeah. Well, I mean, to your point, also liquidity is going to become an issue at some point. And I think that could be why we're seeing these velocity, the velocity in the swings, 1, 2, 3, 4% round trips and the averages.
Correct.
I would imagine there's some, liquidity under the surface too, that you have to be thinking about. But to wrap up here, if we think a little bit higher level,
yep.
U.S. equities, thinking of the U.S. dollar, what's your outlook there?
So I'm actually, and I think we're starting to see some of the moves already, particularly some against these emerging market and LATAM currencies have started to move. I think we're starting to see a topping out process in the US dollar. I think given how hawkish the Fed has been, it's amazing how poorly the dollar has actually reacted. And I think, had it not been for Ukraine, I think the euro would have been significantly higher. But I do think that's changing. And I think that has a huge ramifications for the relative performance of US equities, Jill. I think people don't understand the power of a rising dollar and US equity outperformance and how the two feed each other in this sort of reflexive, self-reinforcing cycle. And I think if the dollar starts to turn, I think we're going to find a situation that if you look at the period from 2002 to 2008 and the things which is when the dollar last had one of its normal cyclical declines, the things that performed in that period are exactly the opposite things that have performed in this period. So tech will underperform, overseas will outperform, commodities will outperform, consumer discretionary will underperform. It's going to be a very radically different marketplace than the one that we've had now.
All right, Julian, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you for having me on the show.